Hi everyone, it's Chad back again with another video. Today I'm going to be talking about Crowdstrike. Stock is down nearly 35% since all-time highs on the 9th of November 2021. Huge drop in just 5 months has been happening all over the growth stock world. Now just shy of a $44 billion company. Plenty of room to run even after tripling since its IPO. I want to try and figure out if this is a buy at these current prices or if there's still a bit to go before it's an acceptable purchase. Crowdstrike is a cybersecurity company and specialises in endpoint security, and its main offering is Crowdstrike Falcon, its cloud-native offering. Falcon is all about different modules, essentially pick and choose what you want and need over time, and Crowdstrike hopes customers take on more offerings over time, as many do. I think now 65% of customers use 4 or more modules. The primary offering is endpoint security and has always been endpoint security. They're slowly moving into other products as the company evolves. You can see there's a ton of things here. I'm not going to go into detail on many of them, and some of them are well above my head. But you can see cloud workload protection, managed threat hunting, next generation antivirus. These are all things that the modern world is going to need going forward. Crowdstrike is frequently cited as the market leader in endpoint security, and they see themselves as one of the name brands that are defining the categories for cloud platforms. The others obviously being Salesforce for CRM cloud, ServiceNow for service management cloud, HR cloud at Workday, and they see themselves as the main player in the security cloud. Big opinion of themselves, as they should do. The scenes are not without competition, as I'll talk about in a minute. The opportunity here is of course huge. It shouldn't be news to anyone that cybersecurity is a massive and growing industry. The total addressable market is large and expanding. They see the total addressable market in 2025, including the new offerings they will make in the next 3 years, as $116 billion. Exactly what I like to see with a young SaaS company. Tons of space to grow. Of course, with a market this large, they will not be the only player. There's tons of money to be had, and heavyweights will get involved. And Microsoft, and in particular, and now potentially Google after this recent acquisition, are the heavyweight players with big cash flows, as well as newcomers like SentinelOne, who are perhaps the most obvious comparison. They're just an earlier on Crowdstrike, essentially specialising in endpoint security. But Crowdstrike is rapidly evolving, is very nimble, and is making new opportunities for itself every day. Look at the most recent financial numbers, absolutely fantastic. Annual recurring revenue is now $1.73 billion, a 65% year-over-year growth. 94% of this is subscription revenue, which has grown at 66% year-over-year, which is of course very high margin. Crowdstrike as a whole business has an 80% gross margin, which is excellent. They now have 16,325 subscription customers, and that has grown at 69% year-over-year, just for customers with 4 or more modules. Again, taking on more modules is part of the story here. Customers need to take on more modules over the time. That can be a big growth prospect for a company like Crowdstrike. Just illustrating further how this annualized recurring revenue, the growth has been rapid and very impressive. From just over 4 years, from $71 million to $1.73 billion. Truly impressive. Shows the power of excellent quarter-over-quarter growth. Company continually smashes analysts' expectations, as it is most recently. And while the growth has obviously slowed from the early days, it looks like it's got no intention of stopping whatsoever. And this is still a tremendously young company. I think it was founded about 10 years ago. You can see it's only really got going in the last 5 or 6 years. Absolutely excellent numbers here. Crowdstrike's customer base is also rapidly expanding, as you would expect, continues to expand at a really fast rate, 65% year-over-year growth, excellent scale here, 65 of the Fortune 100, 250 of the Fortune 500 and 15 of the top banks as of January this year are all using Crowdstrike. Crowdstrike is a classic land and expand SaaS company. Get customers in and sell new modules. These numbers will only go up in my opinion as cybersecurity becomes more and more a focus of the modern businesses. Crowdstrike has a 123% dollar-based net retention rate, and it's consistently maintaining above 120%. Customers on average are spending 20% more a year, and this is exactly what Crowdstrike needs to be doing going forward. This is a fantastic number for a company of this scale. It's not the best you'll ever see. There are of course excellent numbers, but 120% is absolutely fantastic. So after my analysis, do I think it is a buy? I have a couple of key concerns. First of all, the valuation. Crowdstrike's valuation, even after the 35% drop, still trades above 30 times trailing sales, which in today's inflationary environment, with a lot going on in the macro, is very expensive. Secondly, is of course, as I mentioned, competition. Microsoft are a big player in this space. Google just made a $5 billion acquisition to enter the space, and SentinelOne are doing endpoint security, are a smaller player that is growing at 100% year over year, and it won't be long before they're a serious contender in this space. Each has to be noted, of course. However, I think Crowdstrike benefits here from huge switching costs, yielding good customer retention, good market share, and seemingly a technology lead, at least over Microsoft and Google. I think the jury's out completely over whether SentinelOne or CrowdStrike have the better offering, and that is not a question for me to answer, but from everything I can see, it's splitting hairs. I like the company, and I love that it regularly exceeds expectations and is keeping up seriously impressive growth at this scale. It has a good moat, mainly due to the switching costs. I like the modular approach that helps them land and expand customers, and it doesn't seem like a huge expense to add the odd module. It's a free cash flow positive company with $2 billion in cash, which is great. It has 80% gross margins and 30% free cash flow margins as the most recent quarter. 80% gross margin and 65% year-over-year growth will command a serious premium. I'm just not comfortable paying 30 times sales for this business, even with all these facts. I'd be much happier buying around $150 and below range, where the price sales get a bit more sensible. However, I am really impressed that it's now a free cash flow positive business and doing so at 30% net margin. That all being said, this is not financial advice, and you should do your own research and due diligence, and if you want financial advice, you speak to a registered financial advisor. Thanks, I'll see you in the next video.